Welcome to Bullshi, the podcast, the weekly podcast where we talk about behavioral economics with a focus on how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I'm the author of the book Bullshift and the host of the podcast. My guest this week is Dennis Mitchell. Dennis is an MBA, a CFA, a CVV. He is the Chief Executive Officer and the Chief Investment Officer at Starlight Capital. He's been in the business for over 20 years and he's held major senior executive positions at a number of different wealth management firms. And prior to joining Starlight, he received the Brendan Wood International Canadian Top Gun Award for 2009, 2010, 2011, and the Brendan Wood International 2012 Top Gun Team Leader Award, among many, many other accolades. Dennis, welcome.
Great to see you, John.
I'm wondering if you could begin by telling us a little bit about what you do at Starlight. Given that you wear both the hats of CEO and CIO, what does your job entail?
Yeah, great question. So I would say, there's two answers to that. The first is, your standard marketing pitch. I'm the CEO, and so the buck stops with me. I'm responsible for sort of the strategic direction of the firm. What is the value proposition of partnering with Starlight? How do we build out the firm? And then as chief investment officer, I'm responsible for our overall investment philosophy, building out the investment team. Again, contributing to business development, contributing to sort of the growth of the overall firm. That's your marketing pitch. That basically defines what a CEO's role is, what a CIO's role is. But at Starlight, we're a little more strategic than that. And so my role really is to maximize how I can grow the value of Starlight Capital. And so it boils down to five things. I manage all of our private investments. I manage our real estate listed securities investments. I do a lot of white paper writing. I support the sales effort. And then I'm responsible for the overall strategic direction and fulfillment of the firm. So I only do five things, John. Anything else that comes on my desk gets pushed down to somebody else. And in that way, a lot of firms fail because they get caught up in the tactical, right? They deviate from the strategic over time and they never circle back to getting on the strategic trajectory. And so my ability to just do five things means that I always make sure that we get back from the tactical to the strategic. And so whether it's as CEO or CIO, I'm always focused on those five things and making sure strategically we are where we're supposed to be.
Let's take a look at doing a little bit of a deeper dive. Your website actually says that Starlight is investment led and client focused, where the goal is to deliver superior risk adjusted returns for investors by using our disciplined approach of focused business investing. And you go on to say that you build concentrated portfolios of high quality businesses where they offer enough return for the risk that they're exposed to. So maybe you can explain a little bit about risk adjusted returns, trying to get the returns, but still managing the risk along the way.
Yeah, and investors generally only worry about risk when the stock market starts to roll over, right? I mean, those risks existed as the stock was appreciating and as the market was going up. It's just investors aren't paying attention to it unless those risks are manifesting in stocks going down. And so, from our standpoint, the stock market is the only entity where people want you to purchase insurance after the calamity has occurred, right? I mean, if you go out and you buy a car, sorry, if you're going to get a car, the government mandates that you have to get insurance, then you pick up the car, and if you get into an accident, you're covered. In the stock market, it's a little different where you make the investment and it's paying off, and then as markets start to get volatile, people want to know if you've bought insurance, right? They want to know if you understand the company, right? They want to understand if the risks that are manifesting, i.e., interest rates going up at a phenomenal pace in a short period of time. They want to know if you're insured against that risk. They want to know if you're insured against regional bank failure, right? All of those are things that should have been considered when you made the investment, as opposed to as they're manifesting in markets and causing multiples to contract. So from our standpoint, we try not to be making long-term strategic decisions as bullets are firing. We want to be reaping the rewards of all of the work and analysis that we did before things started to go sideways or down. So I think that differentiates us a little bit, and that speaks to when we talk about risk-adjusted returns. Investing is one of those few things where you get to ring the bell when you make the decision, because you've actually created the value when you've made the investment, as opposed to when the market decides that it agrees with you and starts to reward you. Right.
Mhm.
So that's kind of the way we look at it. And when we talk about risk, I think risk is most commonly measured as volatility, right? Beta,
Mhm.
specifically volatility. We don't look at it that way. It's risk to us is the potential for the permanent loss of purchasing power, right? So if I buy a stock at 20 bucks and I think it's worth 40 and it trades down to 18 before it goes to 30, going from 20 to 18, that to me doesn't represent risk. That's just volatility in the market and further proof that I can't call the bottom of anything. Okay. But what we're looking to avoid is buying a stock at 20 that we think is worth 40 and then discovering a year later that it's actually worth 10 and it's trading at 8.
Right.
So those, that to us is a permanent loss of purchasing power, and we want to avoid that. And so the key for us in doing that, you mentioned focused business investing in our investment philosophy. First is we build concentrated portfolios. And the reason for that is simple. It's easier to stay on top of 20 companies and, in the various industries and drivers of revenues and risk than it is to stay on top of 80 companies, right? And we also think that it makes more sense to put money into your 10 best ideas rather than putting money into your 30th, 40th, 50th best idea, right? And then when we talk about, high quality businesses, regardless of sector, geography, they all have four attributes: strong recurring free cash flow from a portfolio of irreplaceable assets that are capitalized with low debt and are run by management teams that behave like owners and treat you like partners. So it doesn't matter if it's Coke or Nike or McDonald's or RioCan or Allied Properties. All of these great businesses have those four attributes. And so a concentrated portfolio of those great businesses should over the long term allow you to compound at a high rate of return with a lower amount of risk than the market as a whole and a lot of active managers in general. So that's
A
that's
lot.
the way we look at it, John.
Good. Okay. So a lot of people, as you're aware, are optimistic about capital markets in general, and they think, oh yeah, I can do this. I can give my money to Dennis or to John or to whomever, and I'll do really really well. Can you perhaps offer your thoughts about the blind spots that a lot of ordinary investors might encounter on a day-to-day basis? What sorts of sort of troubles lurk behind the corners or around the corners that a lot of people might not be thinking about when they invest with nothing but the best of intentions?
Right. And I think if you come back to that word invest, I think the first challenge is that a lot of people aren't investors. They are
Mhm.
traders, right? And if you look at a lot of the news that's on social media or on conventional linear TV, a lot of it just reinforces this trading mentality. How are you positioned for this event? How are you positioned for that event? What are you going to be doing in the portfolios as a result of this happening? Whereas it really should be driven by the companies in your portfolio. Are they actually impacted by this event or that event? Right? A lot of the volatility in the market should just serve as an opportunity for you to either reap the rewards of the work you did or take advantage of the work that you did, either way by buying or selling. So I think the first challenge is that people think they're investors, but in reality they behave like traders. And it's a lot harder to string together 20 good decisions every day, 5 days a week, than it is to string together two or three really good decisions this month and follow them up with two or three more next month. So we talked about the fact that a lot of investors claim to be investors, but in fact behave like traders, and the challenges of stringing together all these good decisions in a short period of time. The other issue we find is that a lot of people invest based on stories as opposed to the actual underlying facts and data of businesses and industries. And I'll give you an example. I can't tell you how many times individual investors have come to me and said, look, Canadians are living longer, we're wealthier, but we're getting sicker. And so I like the seniors housing space in real estate. Why don't you own more seniors housing, Dennis? And I always have to kind of explain how the industry works, right? That's a great story, but here are the facts, right? There are three different buckets of seniors housing: independent living, assisted living, and long-term care. And they have different risk rewards. They have different trajectories in terms of revenue growth, different abilities to create new supply, right? Long-term care is regulated. Independent living and assisted living aren't. So that impacts the economics of these industries. Long-term care, revenue stability, but very low revenue growth and cash flow growth and challenging margins. On the other hand, you have in independent living and assisted living, you have the ability to grow revenues much more significantly and expand margins, but there's also nothing limiting new supply coming into the market. So what you find is that a lot of people who get seduced by stories, run into the realities of the economics of the underlying industry, and they get frustrated because they say, I don't understand. Like, this is a story that's supposed to have all of these long-term drivers of demographics and aging and all of this working for it. Why am I not getting better returns? And so those are two things that I run into all of the time, that, people are really positive about stories, right? And people are really positive about their ability to game events, right? Central bank
Right.
rate hikes or rate decisions, right? And in reality, people are very poor at sort of making those calls around big macro events, getting them right even directionally. And then people get seduced by the story, and it makes them feel like they don't need to do the core fundamental work that actually underscores a sound investment.
One of the things we talk about a lot on this podcast is behavioral finance in general and the behavioral quirks that are part and parcel with financial decision making. And I wanted to say I want to give you props because I was looking at the Starlight website before we did this interview, and I was looking at some of the things that you reference on your website as being the sorts of things that financial advisors can help their clients navigate. And those include anchoring, loss aversion bias, familiarity bias, and of course, overconfidence. Those are all the sorts of things that are the bugaboos that people like me, people who give advice to retail clients, have to deal with on a regular basis because people oftentimes don't know what they don't know. They have their mental model, as you say, they have a story, they have a narrative that they've bought into, and they haven't fully appreciated that they themselves may have a bias. And I'm wondering if you have any thoughts about what can be done to help advisors ethically, honorably, respectfully help to nudge their clients toward making more dispassionate, reason-based, evidence-based decisions that will hopefully lead to better long-term outcomes.
Great question. And I think the biggest challenge is making sure people understand what an acceptable rate of return is. I think a lot of people get it into their heads that they need to make 12%, 15%, 20% annually in order to be able to retire or enjoy the standard of living that they choose for themselves. And
Mhm.
markets just don't support those types of returns over long periods of time. I wish,
Yeah.
but they just don't. And you have to take it back to, and so your question specifically is, how can advisors help with this? I think the number one thing that advisors can provide their clients is education and knowledge and facts and data, right? To reinforce what they should expect. One of the things I used to say early in my career to my team is that we don't want all of the money on Bay Street or all of the money in the world. We want to partner with advisors who understand how we manage money, who believe in that philosophy and want to partner with us for the long term. Then they know what they're getting. They can more accurately fit that into their overall practice, and then we can partner for the long term. And I think turning that back to advisors is, you don't want every single client. You want the client who understands your philosophy, believes in it, and wants to partner with you long term. And I think the best way to build that relationship is provide them with facts, data, and the number one thing I find is that investors think they need to compound at 15 or 20%. And if they're not compounding at those rates, well, something must be wrong. And so I think if you come back and you tell people, look, earnings and revenues in the stock market grow at about a 4 to 6% range consistently over long periods of time. And that's just a function of sustainable levels of growth in the global economy. If you start with that as your baseline, that's your expectation set. And around the margin, you can, sort of goose that up or protect yourself on the downside by just being very disciplined. And I
I,
think the
I
more that clients have that as their baseline of understanding of what's possible, they'll be more appreciative when you've preserved capital to the downside, and more appreciative when you allow them in a few odd years to earn better than that.
I could add that just this past week on Twitter/X, I ran a poll and I asked people for a 60/40 portfolio over a long 20-year plus horizon, what's a reasonable expected return if you're working with an advisor? And the options were less than 4%, 4 to 6%, 6 to 8%, or more than 8%. And I think I'm more or less happy to report that over half the respondents chose the 4 to 6% option as a reasonable expected rate of return for a 60/40 portfolio over a fifth of a century. So
Now, John,
that's actually a good way to do that.
that is a good way to do that, but I'll point out the bias in your process. The guys who are following you, John,
Yeah.
are predisposed to be sensible, rational
Right.
investors with a longer term focus and a more sort of rational grasp on what's possible. I'll bet if an advisor who pursues a more momentum based strategy did a similar poll, it would be way off the charts instead of 4 to 6. So
You're
not
you're
not
you're being very kind to my Twitter followers.
No, I think you know what? I think that like attracts like, right?
There you go.
I've heard a lot of people say your vibe attracts your tribe. I
Yeah.
think that you've got a very rational, fact and data based process, and that attracts similar people who have a similar philosophy. So I'm not at all surprised that the people who follow you on Twitter/X are grounded in more reality and gravitate towards your approach.
Do you think people are aware of their own biases? I wanted to come back to that. One of the problems about bias is that sometimes bias can be unconscious. Everyone has bias.
Mhm.
To what extent do you think it's a problem that people don't realize that they have bias?
I think that people are aware of some of their biases and proudly celebrate some of their biases. But I think people would be surprised to the extent that they have biases on just about everything. So I'll give you an example. People who are active on, online dating websites, they know that they have biases, right? I like tall people, short people, blondes, brunettes. They know that they have biases, and in that forum, they proudly celebrate them, right? I think people would be surprised to know that they have biases around their investing or around other things that are sort of more fundamental that they think they have a more dispassionate, sort of detached approach towards. And that's where the challenge comes because unless you're aware of the bias or unless you're aware of sort of the weak spot, you don't take steps to shore it up or to eliminate it. And it can lead to very negative outcomes in the world of investing in rapid order.
Yeah, it's a really great way to put it, and it's funny because I frequently stop and speak to my wife and speak to my friends, and think about myself. Am I being biased here? And I try really hard because I write about it to be as dispassionate and as evidence based as I can. But I'm biased. I admit I have biases, and I have to try to find a way, exactly as you said, to control them. This has been fascinating. I have to wrap it up because I want to be really respectful of your time. You've been very kind. So we always end these podcasts with two things. And the first is that's bullshit. And that's bullshit is where I ask people to talk about something, anything in the financial services industry that they think could be better. What is there anything in the financial services industry that Dennis Mitchell thinks could be improved upon?
Absolutely. And I think, particularly for Canadians and particularly right now, we need more innovation. And, I won't say that it's a massive negative because if you look at the Canadian market, we have a lot, especially in the financial services, we have a lot more stability and resiliency than sort of our partner to the south, who is often celebrated globally. All you have to do is look at the financial crisis, to see that there's more resilience and stability in our banking system, right? Our insurance companies. And so that's great, but I think where we lack and where we lag behind is in innovation, right? And in growth and in pushing boundaries and creating solutions that'll allow people to get from where they are to where they want to be faster, more efficient, or even arrive there. And so I've seen that starting an asset manager in this country 6 years ago. I've seen that there isn't the same sort of welcoming and opening environment and approach towards innovation and creating new firms and product innovation and bringing new solutions here. We really do have a bit of a closed network here that doesn't really do its best at embracing innovation and productivity. And the reason I say that's topical is we can see right now that productivity of the Canadian workforce is actually declining. And that should never happen for a G7 country with all of the inherent advantages that we have as Canadians. So that's one thing that I would certainly change.
Okay, that was good. So let's then move on to the second half, which is shift happens. And if it was up to you, what would you do to change the problem that you just identified of not enough innovation in Canada? What would you do to fix the problem you've just identified?
Right. So, first off, the financial services industry is key to every industry in Canada because it's the intermediary between people who have capital and people who need capital. So, I would foster innovation there first, right? I mean, we have six national champions on the banking side of things. there's no reason why we can't have more institutions here that act as intermediaries, providing capital to those who need capital, to those who have ideas. And it doesn't just have to be the banks, right? I mean, we should be building up more venture capital in this country. We should be building up more private equity in this country. We have a phenomenally well-educated population. What we need to do is arm them with more ways to get the capital they need to start businesses, to innovate, and to bring new solutions here that create jobs and wealth and and allow Canada to take their rightful place as one of the leading economies on this planet. So I think that's where it needs to start. More innovation in financial services such that we get more capital from people who have it to people who need it. And hopefully those people who need it are overwhelmingly Canadians who, again, drive productivity and drive wealth creation in this country.
That's a really positive way to end. I love that. That's great because, so many of my other guests have things where, well, I don't know what I would like, but this was a really positive, inspirational message in terms of what we can do and what we can and how we can do it. So I want to thank you for that. And of course I want to thank you for your being with us today. Dennis, thank you so much. And it's been a real pleasure.
Thanks, John, and anytime.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.